yesterday we saw Lloyd's reporting something a little different, under a bit of pressure as consumers shop around for higher rates of interest on savings products. How should we look at net interest margin with all the volatility around rate expectations? What's your sensitivity to the rate environment there?
Well, Anna, thank you very much for having me. And as you say, these results are entirely in line with our expectations and with what we put out on our Investor Day about 10 weeks ago. At that point, we said that we had a target for 2026 returns of 12%, 10% in 24. Our first quarter ROTE is 12.3%, which is entirely in line. Our income numbers are in line, our costs are in line, and our capitalization is in the middle of our range at 13.5% on CET1. As far as net interest income goes, you know, the rates markets have been volatile. There's been a round trip approximately of 90 basis points down, 90 basis points back up in the 10-year gilt in the UK, and roughly the same numbers in the US. And so it is very early. Our numbers are in line with what we said. We've seen deposit growth. We've seen lending growth in mortgages and in credit. And so we're pleased with that. But it's one quarter in a longer journey of 3 years.
Yes, it is. I mean, some of the talk at the margin has been a little bit more on the hawkish side, the higher for longer arguments producing that 90 basis points round trip to the upside most recently, Venkat, as you mentioned. So where does that leave us then? As we go through the rest of the year and we look at what happens to rates, what does that do to net interest margin? Give us a sense of the sensitivity.
Well, I think net interest margin, obviously, when you have higher rates, you have a better lending difference. You pay more in deposits, but you get more in lending, and there's a firmness in the markets. But, you know, rates are very, very volatile, so I would shy away from predicting a number in just the first quarter of the year.
Venkat, good morning. It's Guy. As you say, the rates market is very volatile, yet Q1 FICC revenue looks a little light. Why is that? And why are we seeing big differences beginning to emerge between banks in terms of the way they're performing in that space?
Yeah. So I think, first of all, within the Barclays investment banking revenue complex, as in any quarter, you'll have some ups and downs. When we look at our own FICC business, one part of it, which is one of our strategic areas, securitized products, has done very well. On the rate side in Europe, we're a little weaker. And then on equities, and we're talking from our equities floor here at Barclays, we've done extremely well. So on FICC, I think it's a bit of the complexion of the business, and it's a bit about where the movement has been. But I think it's hard to read into any one bank in any one quarter. You've got to see the trend over a longer time.
OK. Do you think the US FICC environment is more conducive to profitability than the European FICC environment? It's interesting, we're going to be talking to BNP Paribas in just a moment, and I'm kind of interested in the compare and contrast between the way that European banks are performing in that space and US banks are performing in that space.
Yeah, I think, you know, for instance, Barclays, we have a fairly big US presence, as you know. I think what you've seen in the US market is more active positioning. The market is, of course, broader across the full range of credit and includes securitized products. So I think there's a greater and richer opportunity in the product set in the US, which lends itself to greater performance by those with bigger US exposures.
It's Kriti in London. Thank you again for joining us this morning. To offset, though, some of that kind of depression that you were seeing in the FICC area, talk to us a little bit how you're viewing kind of the capital markets, the deal flow as well. Is there enough momentum there or early signs of momentum there to offset some of the pain perhaps in the bond business?
Yeah, so I think deal flow and the equity markets themselves have been starting to show some buoyancy. As I said, we are on our equity floor here, and then our own numbers in equities have shown an uptick for this quarter versus the same quarter last year. I think deal flow is increasing. You know, in our own energy business or our sustainability business and the transition business, we've seen 9 deals in the last quarter and a bit. And so I do think that there is a deal flow happening. I think, though, it's very early. You've got to give it a quarter or two to cement.